Welcome back to another deep dive.
Good to be back.
If you've been with us before, you'll probably remember our previous exploration into CitaGlobal Q1. We spent some time digging into their pretty diverse business segments, and that interesting turnaround we saw reflected in their 2023 financials.
Mm-hmm. Yeah, we started putting together that picture, didn't we? Looking at their core operations and, where they were heading strategically.
Exactly. Well, the story continues, as it always does. We've just gotten our hands on their latest source material, specifically the interim financial report for the quarter ending March 31st, 2025. Plus, there's some additional context from recent announcements as well.
That's right. And this new material is, well, it's crucial, really. It gives us a fresh look at how they actually performed in the first 3 months of 2025.
Right.
And it updates us on the progress of those strategic initiatives we talked about last time. It lets us see, the next chapter unfolding based on the latest numbers and activities.
So our mission today, it's pretty much the same as always, but with a fresh set of data points to work with. We're here to take this stack of information, try to cut through some of the corporate speak and financial jargon, pull out the most important nuggets of knowledge and insight, understand what they really mean, and connect the dots for you.
Yeah, hopefully by the end of this, you'll have a really well-informed picture of where CitaGlobal stands right now, specifically based on this Q1 2025 report.
Exactly. Let's roll up our sleeves and unpack this.
Let's do it.
All right, let's start where most people do the headlines, the big top-line numbers that usually grab the attention first. What do the revenue figures and the overall profit before tax tell us about this first quarter of 2025 compared to, say, previous periods we've looked at? What's the immediate takeaway from the income statement?
Okay, yeah, diving straight into the condensed consolidated statements from the report. The group registered revenue of RM 74.8 million for the quarter, ended 31 March 2025.
Okay, 74.8 million.
That's the total amount of money they brought in from their various business activities during those 3 months.
Right. And how does that stack up?
Well, you always need context, right? So let's compare it. Compared to the same quarter last year, Q1 2024, we actually see that revenue decrease slightly.
Okay.
It went from RM 78.1 million in Q1 2024 down to that RM 74.8 million figure in Q1 2025. So that's a difference of about RM 3.3 million, representing a decrease of roughly 4% year on year. So, a small dip compared to the start of last year.
Okay, slight dip year on year. That's interesting in itself, especially, after the positive trend we saw in their full 2023 results. But how did it compare to the immediately preceding quarter, the end of 2024? Sometimes sequential performance gives you a different vibe than year on year. How did Q1 2025 stack up against Q4 2024?
Yeah, and this is where the picture changes quite significantly and frankly becomes more notable from this particular report. Looking at the quarter-on-quarter performance, revenue decreased quite sharply. Yeah, it went from RM 96.4 million in the preceding quarter, that was Q4 of 2024, down to that RM 74.8 million in this current quarter, Q1 2025.
Okay, so 96 down to 75 roughly.
Exactly. That's a substantial decrease of RM 21.6 million.
Wow, that's a much, much larger drop quarter on quarter. Almost a RM 22 million step down in revenue from just the previous 3 months. That is significant. So the kind of headline insight on revenue from this report is that considerable sequential decline to the end of last year. What segments contributed to these changes? Where did that revenue decrease come from, both the year-on-year bit and that larger quarter-on-quarter drop?
Right. The sources break this down for us, which is helpful. That year-on-year decrease, the 4% dip, was mainly due to lower revenues, specifically from their civil engineering and construction segment. They call it CEC.
Right, CCC.
As well as their property and manufacturing segments. However, that decrease was partially offset by higher revenues coming from the energy segment and what they sort of grouped together as the remaining segments.
Right.
And the report specifically highlights a RM 2.7 million increase coming from the telecommunications division, which falls under those remaining segments.
Got it. So telecom helped offset some of the drag year on year.
Yeah. Now for the quarter-on-quarter drop, that much larger RM 21.6 million decrease, the lower revenue was more widespread. The sources state decreases were seen pretty much across the board in CEC, energy, property, manufacturing, and the remaining segments.
Ah, okay. So that sequential step down wasn't just isolated to one or two areas. It sounds like most parts of the business saw lower revenue compared to the end of 2024.
That seems to be the picture, yes.
So the overall revenue picture for Q1 2025 is, well, a bit of a mixed bag maybe. A slight year-on-year decrease, but a quite notable and broad step down from the immediately preceding quarter. That sequential drop is certainly something that stands out. How did this translate to the bottom line then, the profit before tax? Because revenue is only half the story, isn't it? Profitability is where the rubber meets the road.
Absolutely. So the profit before taxation, or PBT, for Q1 2025 was reported as RM 4.152 million.
Okay, 4.15 million PBT.
And comparing that again against Q1 2024, where PBT was RM 4.644 million, the profit before tax in Q1 2025 was lower by about $500,000 ringgit, RM 0.492 million.
Right.
That's a decrease of 11% year-on-year. So profit declined slightly more on a percentage basis than revenue did compared to the same quarter last year.
Okay, 11% down YoY and sequentially against Q4.
And yeah, similar to the revenue trend, the drop was much more significant when compared to the immediately preceding quarter. Against Q4 2024, where PBT was RM 10.391 million.
Wow, okay.
The Q1 2025 PBT, RM 4.152 million, was lower by RM 6.2 million. So yeah, the sequential drop in PBT really mirrored that significant sequential drop in revenue we just talked about.
Okay, that gives us the headline figures then. Revenue down slightly year-on-year, down notably and broadly quarter-on-quarter, and profit before tax also down in both comparisons, with a particularly sharp sequential decline. That sequential drop in both top and bottom line is quite striking and it immediately makes you ask, well, why? All right, so we know overall profit decreased, especially quarter-on-quarter. That leads us straight to looking at the margins, doesn't it?
Right.
Because margins tell us how efficiently they're managing costs and converting that revenue into actual profit.
Right.
Did costs just balloon disproportionately? Or was it primarily a volume issue driven by lower revenue? What do the different margin figures show us in Q1 2025?
Okay, let's break down a few key margin figures. We can calculate some from the statements. We'll start with the gross profit margin. So this is your revenue minus the direct cost of goods sold or services provided. For Q1 2025, the gross profit was RM 15.852 million on that revenue of RM 74.782 million. That gives us a gross profit margin of approximately 21.20%.
Okay, 21.2%. How does that compare?
Now, this is actually quite interesting. This gross profit margin for Q1 2025 was higher than in Q1 2024.
Oh, really?
Yeah. In Q1 2024, gross profit was RM 15.666 million on revenue of RM 78.074 million, which translates to a gross margin of about 20.06%. So even though their revenue was lower year-on-year, their direct costs relative to that revenue actually improved a bit, leading to a slightly better gross margin. Gross profit itself was up about 1% year-on-year.
That is interesting. Gross margin improved year-on-year. So if their efficiency at the, basic level of delivering goods or services improved, where did the decline in the overall profit before tax margin come from? Because we saw the PBT margin was lower year-on-year and sharply lower quarter-on-quarter. What's happening after the gross profit line?
Exactly. That tells us the pressure is coming from costs below the gross profit line. So let's look at the profit before taxation PBT margin. For Q1 2025, it was approximately 5.55%. That's the RM 4.152 million PBT divided by the RM 74.782 million revenue.
Okay, 5.5%.
And this is indeed lower than Q1 2024, which had a PBT margin of about 5.95%. And critically, it's significantly lower than Q4 2024, which, remember, had much higher revenue and delivered a PBT margin of approximately 10.79%.
Big difference from Q4.
Huge difference. We can also look quickly at the operating profit margin, which is basically PBT before you account for finance costs and investment income. That also decreased year-on-year from 5.99% in Q1 2024 down to 4.87% in Q1 2025.
So gross margin looked relatively healthy, maybe even improved year-on-year, but operating and PBT margins definitely declined year-on-year and saw that sharp fall quarter-on-quarter. This strongly suggests increased costs below the cost of goods sold line are squeezing those margins. What does the report actually say about those specific costs? What drove that?
Well, the report points directly to two main areas. Firstly, operating expenses increased. The sources note that operating expenses rose by a significant 21% year-on-year.
21%, wow.
Yeah, this includes things like administrative costs, selling expenses, general overheads not directly tied to cost of goods sold. That substantial jump certainly eats into your operating profit.
Absolutely. And the second area?
Secondly, finance costs. They saw a very significant increase. This is the cost of their borrowings, their debt. Finance costs rose a massive 218% year-on-year.
Whoa, 218%.
Yeah, from just over $500,000 ringgit, RM 0.522 million in Q1 2024, up to RM 1.658 million in Q1 2025. This substantial increase in interest expenses was a major factor hitting that profit before tax figure, obviously, as it sits just above the PBT line on the income statement.
That's a huge jump in finance costs, more than tripling their interest payments year on year. Is that because they took on significantly more debt, or did interest rates spike, or maybe a combination? The report doesn't explicitly say why, does it? But the impact is clear.
No, the report doesn't provide that level of detail on why the finance costs jumped so much in this specific quarter. But seeing a 218% increase is certainly a point you'd want to flag and watch for future clarification. Right?
Totally.
It could be tied to new project financing, higher rates on existing debt, maybe a different mix of borrowings. But regardless of the cause, it had a material impact on the PBT this quarter.
Okay, let's also look at an approximation of EBITDA margin. Now, EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a non-GAAP measure, I know, but it's often used as a kind of proxy for operational cash flow before you factor in those non-cash items and financing or tax decisions. Stripping those out gives us another view of operational performance.
Right. So approximating EBITDA for Q1 2025. Let's see, you take the PBT of RM 4.152 meters, you add back depreciation, which was about RM 5.2 meters for property, plant, and equipment, plus another RM 2.8 meters for right-of-use assets. Add back amortization, about RM 0.3 meters. There was a small impairment loss on receivables, RM 0.08 meters, and crucially, add back those finance costs of RM 1.658 meters.
Okay.
You add all those back to PBT, and you get roughly RM 14.177 million.
14 million-ish EBITDA.
Yeah, and this results in an approximate EBITDA margin of about 18.96%. That's the RM 14.177 meters divided by the RM 74.782 meters revenue.
Okay, nearly 19% EBITDA margin. How does that compare?
Interestingly, this approximate EBITDA margin is actually higher than the Q1 2024 approximation. Back then, it was about RM 12.201 million or 15.63%.
Huh. So like gross margin, EBITDA margin showed a year-on-year improvement. That suggests that at a very high level, before you account for those increased operating expenses, the big jump in finance costs and the non-cash stuff, their operational effectiveness relative to revenue actually looked a bit better than the prior year's quarter.
It seems so, based on that approximation, yes.
Okay, so gross and EBITDA margins look relatively healthy or even improved year on year, but operating and PBT margins declined year on year and saw that sharp fall quarter on quarter. It's pretty clear there are some significant expenses coming into play after gross profit, but before PBT specifically, those operating expenses and finance costs that are really impacting the final reported profit figure.
Exactly. And beyond those increased operating expenses and that significant jump in finance costs we just discussed, there's another factor, perhaps the most crucial factor impacting the reported PBT for Q1 2025.
Oh. What's that?
The sources explicitly highlight a significant one-off gain of RM 1.4 million.
A one-off gain. Okay, right. That's absolutely critical information because one-off items, they distort the picture of ongoing performance, don't they? Where exactly did that come from? Was it related to their day-to-day operations or something else entirely?
This game is definitely something outside of their core recurring operational activities. It arose from what the report calls the deemed disposal of CitaGlobal Energy SDN BHD CGE.
Deemed disposal. Okay, accounting speak. What does that mean in plain English?
Yeah, it doesn't necessarily mean they sold it for cash like a normal sale. Yeah. In this case, it happened because another company, Dayamaju, acquired an 80% stake in CGE through a subscription agreement.
Okay.
So what happened is CitaGlobal's ownership interest in CGE dropped from 100% down to just 20%. Because they no longer hold a controlling stake, CGE isn't accounted for as a subsidiary anymore on CitaGlobal's books. It's now treated as an associate company.
Right, because they only own 20%.
Exactly. And when you lose control of a subsidiary and keep a non-controlling stake that becomes an associate, accounting standards basically force you to remeasure your remaining interest, that 20% stake, at its fair value at that specific moment.
Oh, okay.
So the RM 1.437 million gain they recognized in Q1 2025 comes from the difference between the fair value of their retained 20% stake and what its value was on their books just before this change happened. So it's essentially a non-cash accounting gain triggered by a change in ownership structure. It's not from their energy segment operations during the quarter.
Okay, that makes it much clearer. It's an accounting gain, a paper gain resulting from a change in how one of their former subsidiaries is now classified because of a deal. It's not from selling energy or building infrastructure this quarter. So that reported RM 4.152 million profit before tax for Q1 2025 includes this non-recurring, non-operational RM 1.4 million gains.
Right.
So if we want to understand the profitability generated purely from their ongoing core business activities in Q1, we really need to strip this out, don't we? What would the profit before tax have looked like without this one-off boost?
Exactly. If you take that out, so without this one-off gain of, let's call it RM 1.4 million, the operational profit before tax from their ongoing activities would be approximately RM 2.7 million.
2.7 million.
Yeah, roughly. Just subtract the RM 1.437 million gain from the reported RM 4.152 million PBT.
That's a really important adjustment for anyone trying to assess the underlying performance from this report. The headline reported profit figure was significantly boosted by something that won't happen every quarter. An operational PBT of roughly RM 2.7 million is substantially lower than the reported RM 4.15 million, and it's also considerably lower than the RM 4.6 million PBT reported in Q1 last year, and way lower than the RM 10.4 million PBT reported in Q4 2024.
Precisely. This adjustment, taking out the one-off gain, it really underscores that the profitability generated from the core business operations themselves was under significantly more pressure in Q1 2025 than the headline reported number might initially suggest.
Yeah.
It definitely raises questions about the level of sustainable profitability the current core activities can generate in the near term, unless things improve in later quarters. Understanding the impact of this one-off gain is a key nuance from this report that you absolutely have to consider.
Okay, that's a critical piece of the puzzle sorted. Let's zoom in on the different parts of the business now. We spent time in our previous deep dive talking about CitaGlobal's diverse portfolio. Civil engineering, property, energy, manufacturing, telecom. How did each of these segments actually contribute to the overall results in Q1 2025? And how does that align with the strategic transition they've been talking about?
Absolutely. So the group's principal segments, as we know, are energy, civil engineering and construction, CEC, property and manufacturing, plus those remaining segments, which include things like telecommunications and others.
Right.
Now, the sources explicitly state, and this ties directly back to our PBT discussion, that the lower group PBT, both that year-on-year decline and the significant quarter-on-quarter drop we saw, was primarily due to lower results, meaning lower profit contributions coming from the CEC and property segments.
Okay. So those two traditional core segments were the main drag on profitability this quarter.
That's what the report indicates, yes.
That's notable because CEC, Civil Engineering and Construction, was highlighted as a pretty strong performer and a key part of that turnaround story we saw in their 2023 financials. What happened in the CEC segment in Q1 2025 then?
Well, the CEC segment experienced lower revenues in Q1 2025 compared to both the same quarter last year, Q1 2024, and the immediately preceding quarter, Q4 2024. And this lower revenue directly translated into a lower profit contribution from this segment for the group this quarter. Management acknowledges this and states they're undertaking initiatives to improve this segment's performance, including actively tendering for new projects. It seems like maybe project timing or completion cycles impacted this segment negatively in Q1.
Right. Could just be the cyclical nature of large projects sometimes.
Possibly. The property segment also saw lower revenues and lower results quarter on quarter. Again, the sources don't give us the explicit why, but its negative impact on the overall group PBT is specifically noted.
So those two core, perhaps more traditional segments faced headwinds and were the primary drivers of the lower overall profit. How did the others fare, particularly the ones like energy and telecom that the company is strategically focusing on for future growth?
Yeah, this is where the strategic direction starts to show some maybe more positive signs, even if the overall group profit was down. The energy segment actually showed higher results, meaning a higher profit before tax contribution in Q1 2025 compared to both the same quarter last year, Q1 2024, and the preceding quarter, Q4 2024.
So interesting, even though overall energy revenue was down quarter on quarter.
Exactly, which suggests improved profitability within the segment itself, maybe better cost management or a different mix of projects in Q1. Its revenue contribution was RM 8.8 million in Q1 2025.
Okay, so energy profitability improved. What about manufacturing and telecom?
The manufacturing segment had lower revenue year-on-year, but again, higher results year-on-year. This also kind of hints at improved operational efficiency or perhaps a better mix of higher margin manufacturing work in Q1 2025 compared to Q1 2024. And importantly, the remaining segments, which house telecommunications among others, also showed higher results year-on-year and quarter-on-quarter. This positive contribution was primarily driven by the telecommunications division, which, as we mentioned earlier, saw that clear RM2.7 million revenue increase year on year.
Okay, so while the traditional segments, CEC and property, were a drag on the bottom line this quarter, the strategic focus areas energy and telecom actually showed improving profitability, even if energy's revenue dipped sequentially. This brings us squarely back to that strategic transition we discussed last time, that deliberate shift in focus towards renewable energy and telecommunications infrastructure. How does this Q1 2025 report show concrete progress on that front beyond just the segment results themselves?
Well, the sources strongly reiterate this strategic direction. They explicitly state the group is in a transition phase, focusing heavily on developing the renewable energy and telecommunications infrastructure sectors. And they expect these sectors to contribute positively and, significantly to the group's future performance.
Right, the stated aim. Any concrete examples?
Yes. A key concrete development highlighted in the sources is the exploration of opportunities in Indonesia. They've partnered with the Muhammadiyah Leadership Institution in East Java. This isn't just vague talk. This is a specific, named partner in a significant new market for them.
Indonesia. Okay, tell us more of this partnership. What details does the source material provide about this initiative? It sounds potentially quite significant.
It does. The sources state they've signed a tentative agreement with this Muhammadiyah Leadership Institution. Apparently, it's a very large, well-established organization in Indonesia with extensive networks, particularly in education and healthcare. The agreement is specifically for exploring opportunities to deploy integrated infrastructure solutions, primarily telecommunications and renewable energy infrastructure, at Muhammadiyah's wide network of facilities across East Java. Think hospitals, schools, universities, that sort of thing.
Yeah, integrated solutions, telecom and RE.
Exactly. And the initial target mentioned for this collaboration is quite ambitious. They're looking at potentially deploying around 250 communication towers and 5 megawatts, MW, of solar power infrastructure across these specific facilities.
Wow, 250 towers and 5 MW solar. That's a decent starting point.
It is. The agreement calls for a joint feasibility study to be completed within 6 months from the signing date. This study will assess the technical and commercial viability of deploying these solutions before they potentially move forward with, pilot projects or larger rollouts.
So a feasibility study first. Makes sense.
Yeah. And management, including the executive chairman cum president, Tan Sri Muhammad Norza Zakaria, provided some commentary on this. He emphasized the strategic importance of Indonesia as a growth market, large population, development needs, and sees East Java, with its population of over 44 million people, as a significant entry point for deploying their integrated infrastructure solutions, combining telecom, RE, and maybe facility management capabilities.
Right.
It's a very clear signal of their international expansion focus within these strategic sectors.
That partnership does sound like a tangible step, aligning perfectly with their stated focus sectors and international ambitions. It's concrete action behind the strategy, not just words. What other strategic moves or, say, project wins are mentioned in the report that provide further visibility or future potential for revenue and earnings?
Well, they highlight some recent project wins that feed into their order book. In January 2025, the group was awarded 2 projects with a combined contract value of RM 36.3 million.
Okay.
Then, just a month later, in February 2025, they secured another 2 projects worth an aggregate of RM 36.1 million. So add those up, that's RM 72.4 million in new project awards secured right at the start of the year.
72 million in new work. Not bad.
No. And these new projects are explicitly expected to contribute positively to the group's future earnings and net assets per share for the financial years ending December 2025 and December 2026. So that provides some clear forward visibility on revenue streams from project execution over the next couple of years.
Good. What about the property segment? Despite the weaker Q1, any strategic moves there?
Yes, actually. Despite the lower contribution in Q1, a significant strategic move was the proposed acquisition of a 1.58-acre leasehold land parcel. It's apparently in a prime location in Kuala Lumpur, and they're buying it from Bank Islam Malaysia Berhad, BIMB, for a cash consideration of RM 73 million.
73 million cash for land in KL. That's a big chunk of change.
It is. The sale and purchase agreement for this was signed back on January 31st, 2025. Management views this land acquisition as a key strategic opportunity for long-term value creation. They specifically point to its prime location, high visibility, excellent accessibility, connectivity to public transport, all the good stuff you look for in development land.
Right.
So while it costs a significant amount of cash up front, the idea is clearly to fuel future property development revenue streams. The proposed acquisition is conditional on certain things, but it doesn't require shareholder approval, meaning management can proceed once conditions are met.
Okay, so a big bet on future property development there. Any updates on other corporate stuff? JVs, options, warrants?
Yeah, the report gives quick updates on some corporate proposals we might have touched on before related to potential land or development deals, things like a joint venture agreement, JVA, an option to purchase, and a bonus issue of warrants.
Mm-hmm.
The resolutions for these proposals were passed at an EGM, an extraordinary general meeting held in April 2025. The conditions precedent for the JVA and the related option agreement became unconditional on April 18, 2025. So those agreements are now legally binding, pending the exercise of the option, basically.
Okay, so they're live now.
Pretty much. And the bonus issue of warrants, which gives existing shareholders rights to potentially buy shares later, that was completed on May 16, 2025, with the warrants listed on Bursa Securities. The structure of the JVA and option is kind of designed so that if the option to buy the development land is exercised, the JVA related to that specific land just ceases to have effect. Essentially, they'll go down one path or the other for that piece of land.
Okay, so looking at all that together, the challenging Q1 financials, especially the sequential revenue and profit drop, and that dependence on the one-off gain. But alongside that, it's abundantly clear the company has been extremely active strategically in early 2025.
Very active.
Securing new projects, pursuing international partnerships in RE and telecom, making a major land acquisition. It really paints a picture of a company aggressively trying to build its future, even if the current quarter's operational performance was, well, a bit weak.
Absolutely. It feels like a period of intense activity focused on shaping the future business mix, even while they're navigating the current operating environment.
Okay, let's shift gears then and look at the balance sheet and cash flow. Beyond just the profitability in a single quarter, what does their overall financial position, their strength and liquidity look like at the end of Q1 2025? You often say cash is king, especially for businesses involved in these large capital-intensive projects like construction and infrastructure.
Right, yeah. Looking at the balance sheet, the statement of financial position. As at 31 March 2025, total assets stood at RM 668.9 million.
Okay.
This was actually a slight decrease from RM 680.3 million at the end of 2024, so December 31st.
Assets down slightly. What about the other side? Equity and liabilities.
Total equity, which is the shareholder's stake after liabilities, saw a small increase from RM 396.2 million up to RM 399.0 million. Total liabilities, meanwhile, decreased from RM 284.0 million down to RM 269.9 million.
Ah, okay. So liabilities came down a bit more than assets did, hence the small rise in equity.
Exactly. And let's look specifically at debt, which is a key part of those liabilities. Total borrowings stood at RM 97.041 million at the end of March 2025.
Under 100 million in borrowings.
Yeah, and this was a slight decrease from RM 103.14 million at the end of December 2024. The breakdown shows decreases in both current borrowings, the stuff due within a year, and non-current borrowings due further out.
Okay, debt came down a bit. How did that look relative to equity? The gearing.
Right. The debt-to-equity ratio slightly improved because of that. It went from 0.26 times at the end of 2024 down to 0.24 times at the end of Q1 2025.
0.24. That seems relatively low, doesn't it?
It is generally considered relatively low, yeah. It suggests lower financial leverage and risk. Of course, we don't have an industry average provided in these sources for a direct comparison to peers like, say, Sunway or IJM, but on its own, a 0.24 is not a high gearing ratio.
Okay, so that slight decrease in debt and the relatively low debt-to-equity ratio seem like positive points on the balance sheet side. But you mentioned cash is king, and you hinted the cash balance dropped quite a bit. What's the story there?
Yeah, this is indeed a point that stands out significantly from the report and really warrants close attention. Cash and cash equivalents decreased quite substantially during the quarter.
How much?
They started the period, January 1st, 2025, with RM 32.938 million in cash and cash equivalents. They ended the period, March 31st, 2025, with just RM 20.113 million.
Oof. So down from nearly 33 million to just over 20 million.
Yeah, that's a decrease of over RM 12.8 million in cash in just 3 months.
That's a big chunk of their cash gone.
It is. And looking at it relative to the size of the company, cash as a percentage of total assets dropped from 4.84% at the start of the year down to just 3.01% at the end of Q1. And maybe more importantly, cash coverage of total liabilities also decreased significantly from 11.60% down to 7.45% over the quarter. That means they have less ready cash available relative to their total obligations at the end of the quarter than they did at the start.
Okay, a notable decrease in their cash balance, over RN 12 million wiped out in a single quarter. Why did that happen? The cash flow statement should tell us where the cash actually went, right? How does the cash flow statement for Q1 2025 explain this drop?
Exactly. The condensed consolidated statements of cash flows give us the clear explanation. And the big one is this. They show a net operating cash outflow of RM 10.255 million.
Operating cash outflow. So operations burn cash.
Yes. This is a critical point. It means that over these 3 months, the core operations of the business, the day-to-day activities of earning revenue, paying expenses, plus changes in working capital like managing receivables and payables, actually consumed cash rather than generating it. This outflow from operations is the primary driver of the overall decrease in the cash balance during the quarter.
Right, that accounts for about 10 million of the 12.8 million drop right there. What about investing and financing activities?
Well, investing activities resulted in a net outflow, but it was relatively small at only RM 0.1 million. This was much lower than the outflow in Q1 last year, which was nearly RM 19 million.
Okay.
Primarily because there weren't any large new investments in property, plant, equipment, or major acquisitions mentioned this quarter, though there was a small cash outflow of about RM 0.4 million specifically related to that deemed disposal of CGE we talked about earlier. That gets classified under investing activities.
Got it. And financing.
Yeah.
Paying back debt, raising money.
Financing activities also had a net outflow of RM 2.468 million. This was mainly due to repayments of borrowings and lease liabilities, which exceeded any cash they received from new drawdowns during the quarter.
Yep.
So you add it all up. The significant operating cash outflow, around RM 10.3 mitters, the small investing outflow, RM 0.1 mitter, and the financing outflow, RM 2.5 mitters, that combination resulted in the net decrease in cash and cash equivalents of RM 12.823 million that we saw reflected in the cash balance.
So the big story from the cash flow statement is really that operations consumed cash this quarter. That, combined with servicing debt and lease obligations, led straight to the drop in the cash balance. This net operating cash outflow seems like a key point for you, the listener, to monitor very closely in future reports.
Absolutely critical.
Does the current ratio, though, the one that looks at short-term assets versus liabilities, does that offer any reassurance about their ability to meet short-term obligations despite the cash drain?
Yes, the current ratio gives us that snapshot of short-term liquidity. Can they cover liabilities due within the next year with assets they expect to convert to cash within that same period?
Right.
As at March 31st, 2025, current assets were RM 400.4 million and current liabilities were RM 240.4 million. So you divide assets by liabilities, and that gives you a current ratio of approximately 1.66 to 1.
1.66. Is that good?
Well, it's actually a slight improvement from 1.62 to 1 at the end of December 2024. The source analysis notes that this ratio is above 1.5, which is generally considered a reasonable buffer. It suggests a relatively healthy short-term liquidity position based purely on this metric.
Okay.
So while the actual cash balance decreased significantly, the overall mix of current assets, which includes things like receivables, inventory, etc., compared to current liabilities, remained reasonably solid, according to this one specific metric.
Okay, so the financial position shows relatively low debt and a decent picture from the current ratio perspective. But that significant decrease in the absolute cash balance and, more importantly, the net operating cash outflow for the quarter are definitely points requiring close attention. It really highlights the pressure on working capital and cash generation from operations in Q1.
Definitely.
Okay. We've seen financial performance for the quarter, including the challenges. We've seen the snapshot of the balance sheet and cash flow, including that concerning cash outflow. But for a company like CitaGlobal, especially with its involvement in large infrastructure and development projects, the order book provides crucial visibility into future revenue streams. What does that pipeline look like based on the source material provided?
Right, and this is where the picture turns, arguably more positive in terms of future potential. As at 31 March 2025, the group had a total outstanding order book of a substantial RM 1.1 billion.
1.1 billion ringgit. That's a really significant figure on its own, isn't it?
Mhm.
Especially for a company of this size. How does that compare to their current revenue run rate? How much future revenue does that order book represent, roughly? And over what kind of time horizon?
Yeah, we can get a rough idea by comparing the order book to the current revenue run rate. So using the Q1 2025 revenue of, say, RM 75 million, if you just annualize it, multiply by 4, which is obviously a simplification, assumes consistency, but gives a useful benchmark.
Right, just a rough guide.
That would be roughly RM 300 million in estimated annual revenue. So based on the simplified annual run rate, that RM 1.1 billion order book would cover approximately 3.68 years of revenue. Let's call it nearly 3.7 years.
Wow, almost 4 years of revenue cover based on Q1's run rate.
Yeah. And this RM 1.1 billion figure includes projects across their various segments, particularly civil engineering and construction. This provides a significant degree of future revenue predictability and visibility over the next few years, which is generally a very positive factor for a project-based company, especially in industries that can be cyclical. It shows they have a substantial pipeline of work already secured.
That substantial order book, covering almost 3.7 years of revenue based on the Q1 run rate, combined with those recent project wins you mentioned earlier, totaling over RM 72 million. That certainly paints a promising picture for future revenue streams, even if Q1 itself was soft.
Yes, and the outlook section in the report explicitly states that the group's performance outlook generally depends heavily on winning contracts from collaborations and tender participations. Those recent RM 72.4 million in project awards are specifically noted as being expected to contribute positively to earnings in 2025 and 2026. Management also reiterated their strategic focus on the renewable energy and telecommunications sectors in the outlook section, expecting them to contribute positively to the group's future. That Indonesia initiative we discussed is a tangible part of this forward-looking strategy in those growth sectors.
Right.
And the property segment, despite its lower contribution in Q1, also adds to the future revenue potential. It has an estimated remaining gross development value, or GDV, of RM 463 million from its existing projects.
Okay, GDV of 463 million.
Yeah, GDV is the estimated total revenue expected from selling the development units once they're completed. So this provides visibility on potential future revenue from that segment too as development progresses and units are sold over time.
So a strong order book, recent wins, re-telecom focus, and property GDV all point towards future activity.
They do. However, it's important, as always, to note what the sources don't contain regarding the future outlook. There is no specific profit forecast issued by the group for the current financial year.
No guidance numbers.
No. They state their performance depends on securing contracts and their focus on growth sectors, which is understandable, but they don't provide a numerical profit target or guidance range. Also, there are no analyst growth forecasts provided within these sources for a comparison against management's generally positive outlook for the focus sectors.
Right.
This absence of specific financial projections limits our ability to quantify future expectations based solely on the provided material.
So the order book provides solid revenue visibility for several years, and the strategic direction towards RE and telecom is clear with initiatives like Indonesia and recent project wins fueling that order book. But the actual financial targets or any external validation of that positive outlook in the form of analyst forecasts just aren't included in these specific sources we're looking at today. Okay. We've looked at the numbers for the quarter, the strategic direction they're pursuing, and the future visibility from the order book. Now let's turn our attention to the potential challenges, or maybe red flags that emerge from this latest information. What should you, the listener, be watching for, especially building on some of the risks inherent in their business and industry that we might have touched on before?
Right. Based specifically and solely on the Q1 2025 report and the accompanying analysis provided in our sources, several points stand out as areas that warrant close monitoring as you follow CitaGlobal's story going forward.
Okay, what are they?
First and foremost, obviously, the declining revenue. That decreased both year-on-year and, more significantly and broadly across segments, quarter-on-quarter. That's a clear challenge. Sustained revenue decline, particularly in key areas like CEC, would obviously impact future profitability and limit their ability to grow.
Okay, revenue decline, number one.
Second, pressure on operational margins. While gross and EBITDA margins showed some positive signs year-on-year, the decreases in reported operating and PBT margins, especially that sharp drop quarter-on-quarter, indicate difficulties in managing costs below the gross profit line. Those significant increases in operating expenses, up 21% year-over-year, and especially finance costs, up 218% year-over-year, are concrete pressures eating into their profitability. You have to ask, are these cost increases temporary or reflective of a more challenging operating environment?
Right. Margin pressure and rising costs. Got it.
Third, reliance on one-off gains. The fact that a substantial portion of the reported Q1 PBT came from that non-recurring accounting gain related to the CGE deemed disposal. That's a significant point. It raises questions about the underlying profitability of the core business activities in this specific quarter. You need to assess whether future quarters can deliver stronger operational results purely from their trading activities without needing such non-recurring items.
Dependence on one-offs.
Fourth, underperformance in CEC. Given that civil engineering and construction is explicitly listed as a principal segment and was a driver of the 2023 turnaround, its lower revenue and contribution in Q1 are significant. The success of management's stated initiatives in this segment, like active tendering for new projects, will be crucial for improving overall group performance. Is this just a temporary dip, or does it signal deeper issues in that segment?
Okay, weakness in a core segment, CEC.
Fifth, net operating cash outflow. Operations consuming cash in a quarter, as seen with that RM 10.3 million outflow, is something that absolutely must be monitored closely. Sustained operating cash outflows would put pressure on the company's cash balance and could limit its ability to fund future investments, like that big KL land acquisition or service debt obligations, without needing external financing.
Yeah, burning cash from operations is never a good sign long term.
Definitely not. Sixth, decrease in cash position. The resulting drop in cash and cash equivalents by over RM 12.8 million during the quarter and its reduced coverage of total assets and liabilities warrants attention. While the current ratio looks decent for now, a shrinking cash buffer could become problematic, especially if operations continue to consume cash or if large cash outlays are required for strategic moves like the land acquisition or mobilizing for new projects.
Right, dwindling cash reserves.
Yeah. And beyond the financial numbers themselves, the sources also highlight what information is not available to us, which impacts our ability to fully assess certain risks or the company's competitive position. For example, they don't contain specific details on how external factors like material costs, steel, cement prices, or potential labor shortages, which are common risks in construction and infrastructure, how those specifically impacted profitability in Q1 2025. This lack of detail makes it harder to gauge how well they're actually managing these external pressures.
Okay, lack of detail on managing external costs.
And crucially, for assessing competitive strength and resilience against rising input costs, the sources explicitly state they do not contain information on CitaGlobal's ability to pass through increased costs to customers, or any comparison of its pricing power or cost management against peers, like larger listed construction or infrastructure players such as Sunway or IJM.
Ah, okay. So no info on pricing power versus competitors.
Exactly. This absence of comparative data makes it very hard for us, based only on these sources, to judge their competitive position and how resilient they are in the face of market cost pressures compared to others in the industry.
So the report highlights some clear operational and cash flow challenges in Q1, points to rising internal costs like operating expenses and finance costs, and importantly, underlines a lack of transparency in the provided sources on how well they can mitigate key industry risks like cost pass-through compared to competitors. These are certainly significant points for you, the listener, to keep in mind as you evaluate the company's situation.
Very much so.
This brings us naturally to the idea of a company's financial moat. Those sustainable competitive advantages that protect its long-term profitability from competition. Based only on the sources we have for this specific deep dive into the Q1 2025 report, we have a scorecard assessment. What does it say about CitaGlobal's financial moat as viewed purely through the lens of this material?
Right. Based only on the limited information provided in these specific sources for Q1 2025 and the accompanying analysis, so we are strictly confining ourselves to what is presented here. The scorecard assigns CitaGlobal a score of 4 out of 10 for its financial moat.
4 out of 10.
Okay.
That suggests, based purely on this snapshot of source material, a fairly limited or perhaps unproven financial moat. What's the reasoning behind that score? What specific evidence or lack thereof in these sources supports that assessment?
Well, the score attempts to weigh the evidence presented in the sources regarding factors that might indicate sustainable competitive advantage or stability. On the positive side, which supports some potential stability or future advantage, the sources clearly show that significant outstanding order book of RM 1.1 billion.
Right, the 3.7 years cover.
Exactly. As we discussed, this provides substantial revenue visibility, suggesting a solid pipeline of work secured against competition. That's a plus.
Okay.
And there's also a clear strategic focus on growth sectors like renewable energy and telecommunications, backed by concrete steps like the Indonesia partnership and the recent project wins. That shows they are active and securing new business in target areas. The balance sheet shows relatively low debt to equity, 0.24, and a reasonable current ratio, 1.66, which indicates some degree of financial stability and reasonable short-term liquidity. And as we noted, the gross and approximate EBITDA margins did show year-on-year improvement in Q1, which could hint at some underlying operational efficiency at the direct cost level, although, it's only partial evidence.
Okay, so those are the points in its favor based on the sources. What about the negatives weighing it down to a 4?
Well, these potential positives are significantly weighed against the concerning recent operational performance indicators we saw specifically in Q1 2025. This includes the declining revenue, particularly that sharp sequential drop, and the pressure on operational profit margins once you exclude that RM 1.4 million one-off gain.
Right.
The reliance on that non-recurring gain for a substantial portion of the reported profit highlights the weakness in underlying operational profitability this quarter. The underperformance in a key segment like CEC and the noted increases in operating and finance costs pressuring the bottom line are also negative factors. And critically, that net operating cash outflow and the resulting decrease in the cash position are significant challenges revealed by the Q1 report.
Okay, the recent performance issues.
Yes. But perhaps the most significant reason for the lower score of 4 out of 10, when restricted only to the provided sources, is the explicit absence of information needed to demonstrate a strong, durable financial moat in the traditional sense.
What's missing?
Well, a strong moat usually involves things like cost advantages that competitors can't match, proven pricing power, enabling a company to pass on cost increases, strong brand loyalty, maybe network effects, or unique protected intellectual property.
Right, the classic moat sources.
Exactly. The sources provided here do not contain evidence for these critical factors. We don't see data demonstrating specific cost advantages compared to their peers. We don't see data showing proven pricing power or strong ability to pass on increased costs. In fact, the sources explicitly state this information isn't there for comparison. There's no discussion in the sources about strong brand loyalty creating barriers to entry or unique protected IP that competitors can't easily replicate, say, in their integrated infrastructure solution.
I see. So the evidence just isn't there in these sources.
Precisely. So the score of 4 out of 10 reflects this mixed picture. Some positive structural elements like the order book and clear strategic intent and some balance sheet stability, but significant current financial performance challenges in Q1, especially operationally and cash flow-wise. And, fundamentally, a lack of the specific evidence within these limited sources needed to confidently assess durable competitive advantages that would truly protect their profitability and market position over the long term against competitive pressures.
Right.
It highlights that while the company is active in pursuing growth, this report does not demonstrate the existence of a wide protective financial moat around its current core operations or its newer strategic ventures.
That makes a lot of sense. It's an assessment strictly limited to the evidence presented in these specific sources, and that evidence shows both strategic ambition and some clear, near-term operational and cash flow headwinds, without providing the necessary clarity or data points to demonstrate a strong, durable competitive edge, particularly in managing costs or pricing against the competition.
So wrapping this up, our deep dive into CitaGlobal's Q1 2025 report reveals a company that's clearly buzzing with activity on the strategic front, no doubt about that.
Very busy.
They're actively pursuing renewable energy and telecommunication opportunities, both domestically and internationally, with that specific Indonesia partnership. They're securing new projects, adding to that substantial order book. They're making strategic acquisitions like that prime KL land parcel for future development. It aligns perfectly with the picture of a company in a significant transition phase that we started to paint in our previous conversation about their 2023 turnaround. But financially, this Q1 2025 period presented some notable challenges. We saw declining revenue, especially that sharp drop quarter on quarter. We saw pressure on operational margins driven by increases in operating expenses and particularly finance costs. We saw a net operating cash outflow, meaning their core business operations used cash in the quarter. And importantly, the reported profit was significantly helped by that one-off accounting gain, underscoring that the underlying operational profitability for the quarter, stripped of that gain, was considerably lower than the headline figure might suggest.
It really feels like this was a period of intense activity and strategic positioning for the future. But the financial results for this specific quarter reflect some definite headwinds. Maybe costs associated with this transition, or just the current operating environment affecting their traditional segments like CEC and property.
That substantial RM 1.1 billion order book does provide significant future revenue visibility for almost 4 years. Absolutely. And the focus on growth sectors like RE and telecom is clear with initiatives like the Indonesia partnership. But execution risk always remains that RM 1.1 billion needs to be translated into profitable revenue and, crucially, positive cash flow.
Right. Execution is key.
Especially as they push into new areas and international markets and try to improve performance in those core but currently underperforming segments like CEC.
This quarter's report really reinforces that CitaGlobal is very much a company actively in transition, navigating real operational challenges while pursuing ambitious growth plans focused on new sectors.
Absolutely. The key for you as you continue to follow their story and evaluate how that puzzle of their diverse business comes together will be to watch whether these strategic initiatives and the order book momentum can consistently translate into improved, sustainable operational profitability and, crucially, positive cash flow in future quarters. Can they achieve this particularly as the impact of one-off gains fades and they have to manage those increasing costs while also executing efficiently on that large order book? That's the million-dollar question, isn't it?
It really is. So what stands out to you from this deep dive? Can CitaGlobal successfully make that pivot? Can they make renewable energy and telecommunications the consistent, profitable engines the company expects them to be, overcoming the operational pressures we saw in Q1 and actually proving they have a sustainable competitive advantage in these strategic areas? That's something for you to consider as you look ahead and await future reports.